Welcome to another episode of Garden of the Mind YouTube channel, where we reduce stress, improve our health and fitness, and increase our financial IQ just a little bit every episode. If you're new to this channel, welcome to our village. Before I get into our topic for today, October is Breast Cancer Awareness Month, so we're wearing our pink in support of those survivors of breast cancer and those of you who are still yet in your fight. We got your back and we're supporting. What is credit? Credit is a reporting system for your debts. It lets people know exactly how you've paid your bills in the past. So for example, if you were looking to learn something about someone, you would talk to those people who are close to that person so that they can fill you in on the details that may not yet be obvious from your interaction with that person. Credit is exactly that. It is your reputation on paper, so people can see exactly how you've paid your bills in the past. It's a way of them finding out whether you are a good or not so good credit risk. Credit is a tool. It can be used either positively or it can be used negatively. We are looking to show you more about credit so that you can stay more on the positive side of credit. Credit is also leverage. There's a saying, you can borrow $1 million faster than you can make $1 million. Now, granted, that's not exactly credit, that's more of finance, but credit gives you the opportunity to access finance. Why is credit important? Well, in this day and age, credit allows you to take part into society in a much more deep way. With good credit, you can get the better apartments. You can buy houses at prime interest rates. You can get cars at prime interest rates. Now, many jobs are also starting to check your credit. If you are in pursuit of utilities in your home, they may check your credit. If you're looking for car insurance, they definitely check your credit. In short, the world can be a very mean place if your credit is not so good. But most people don't understand credit. So what they would rather do is they would rather just wait as long as they possibly can and hope that their credit magically increases on its own. Credit is a snapshot of your paying history, and it's constantly moving in a 7-year period. So it goes just like this. So if you have a bad debt and you had that bad debt about 7 years ago, depending on what it is, it's supposed to come off of your credit report. If you don't have any other bad debts after that point, then you can work yourself into having some good credit. But you have to know the rules. In order for you to learn this game and for you to play it well, you've got to know the rules. So hopefully you learn a little bit here today. Credit allows you to have the prime interest rate when it comes to financing. Example, let's say you borrow $10,000, maybe for a car, I don't know, and your credit is bad. Over the life of the loan, if you're even able to get that with bad credit, you would probably end up paying about 4 times the amount of that loan. So by the end of the 5 years or whatever the term is, you would probably end up spending $40,000 to gain access to $10,000. If you have moderate credit, you may pay $25,000 over the life of the loan. Now, if you have good credit, you may pay $20,000 over the life of the $10,000 loan. But some of you are probably saying, Pachaka, that's still double of what you'd pay for it. Well, there's a price for financing, and usually financing is a way of you gaining something today using your income from tomorrow. So it's a way for you to leverage your resources in order for you to benefit today. So you're going to spend something on it. The person who has good credit would have been able to buy 2 cars at the same rate as someone who had bad credit if they were even able to get the loan. If your credit is not optimal, you may not even get a loan at all. If you were to get a loan, they're going to charge you so much, it might not even make any sense for you to even get the loan. But in that situation, you don't have a whole lot of choices, so you got to take whatever it is that they give you. What good credit allows you to do is it allows you to have choices. Good credit also allows you confidence in the negotiation, because if you know that you're a very good credit risk, you can determine exactly what you want out of the deal. You can say, listen, if I can't get this at this particular interest rate, then I'm not doing the deal. And they may or may not accept your terms. Most of the times, if you do have good credit, they'll usually try to at least work with you because they know that you can take your show down the road somewhere and they'll lose your business. When you have good credit, you have options over financing, over terms, you have flexibility, and you can negotiate in a stronger position than if you didn't have good credit. Now, once you get a copy of your credit report has your credit score on it. Now, your credit score basically tells exactly how good of a credit risk you are. It ranges from 300 all the way up to 850. 850 is optimal. However, good credit is anything over 670. If you got a 720, you definitely have good credit. If you have an 850, that's just kind of for vanity and bragging rights. You can still get the same things with the 670 that you could with an 850. If your score is between 600 and 670, that's fair. Anything under 600 is usually considered not so good. There are 4 credit bureaus. Well, there's 3 that are utilized the most, but there's actually 4. There is Experian, Equifax, TransUnion, and the 4th company is called Innovis. Most people don't know anything about Innovis. Each of these credit reporting agencies are just that. They are private credit reporting agencies. They are completely separate from the government, and they do not report to the government. As a matter of fact, on your credit report, it doesn't even have your salary on it. Each of these credit reporting agencies do just that. They report your credit history. Why do you need 4? Well, you really don't. That depends on the preference of the company that is soliciting that report. So, for example, one bank may solicit only Equifax and Experian. The other one may only go with Innovis, while another one may only go with TransUnion. That's why you can have 4 different credit scores for each one. Each company has their own way of determining your credit score. Each of them works out the numbers a different way. They all have their own secret sauce, and they don't usually share that with the public. But usually the breakdown is this. You have 30% of your credit report coming from your payment history. Another 30 coming from your credit utilization. That is whether you have revolving debt or installment debt. Revolving debt is credit cards, things where you keep a balance and you pay a little bit every month. Installment loans are car loans, student loans, maybe house payments. Another 30% comes from the length of your credit history. The final 10% comes from inquiries. So if you are trying to get new credit, then that shows up as an inquiry and it actually drops your score a little bit up until about a month or 2 months. Then your score goes back up to what it was before. But inquiries do play a small part in your credit score. I am expecting plenty of questions in the comments. So please, if you have any questions about credit, please put those in the comments and I'll make sure to discuss that in our next episode of Wealthy Wednesdays. If you like this episode, please give it the thumbs up. If you like this channel, please subscribe. If you want to know when I post, which is Mondays, Wednesdays, and Fridays, but the exact time, click on that notification bell so that you can be the first one to hear exactly what was said here. And remember, thoughts are actions, words have power, and actions have consequences. I will see you for Fitness Fridays, where we will discuss how to make the perfect smoothie. I'll see you soon.